Have you ever placed a trade, your analysis was perfect, your entry was perfect, and then your stop loss gets hit, and right after that, price goes exactly where you predicted? That's not bad luck, that's liquidity, and the institutions did that on purpose. Today I'm going to explain exactly what liquidity is: buy side liquidity, sell side liquidity, equal highs and equal lows, and the stop hunt, and how to use all of this to stop being the one who gets stopped out. Let's go. In trading, liquidity simply means orders sitting in the market waiting to be executed. Every buy order needs a seller, every sell order needs a buyer. For a retail trader like us, this is never a problem because our orders are tiny. But imagine you are a bank that needs to buy $1 billion of EU. You cannot fill that at one single price. There isn't enough volume there, and your own order would move the market against you. So what do institutions do? They go where the orders are already concentrated, above swing highs and below swing lows. That's where retail traders place their stop losses and their pending orders. That's the liquidity the institutions are hunting. This is the entire game of the market. Buy-side liquidity sits above swing highs and equal highs. When traders go short, they put their stop above the last swing high. When breakout traders want to go long, they place pending buy orders above those highs. So above every swing high, you have two types of orders stacking up: stop losses and pending buys. When institutions need to sell, they push price up into that zone, trigger all those orders, use the buying volume to execute their sell orders, and then let price drop. That's why you see price spike above a swing high and immediately reverse. Sell side liquidity is the exact opposite. It sits below swing lows and equal lows. Long traders have their stops below the swing low, and breakdown traders have pending sell orders there. When institutions need to buy, they push price down into that zone, trigger all the sell orders, use that volume to execute their buy orders, and then price reverses upward. The rule is simple: buy side liquidity above, institutions sweep it to sell. Sell side liquidity below, institutions sweep it to buy. Equal highs are two or more swing highs at the same price level. Classic analysis calls this resistance. In smart money concept, it's a liquidity pool, a massive concentration of orders sitting above it that the institutions will sweep. Equal lows are the same concept on the downside, classic support, but in smart money concept, it's sell side liquidity. The rule is simple: the more obvious a level is on a chart, the more likely it is to be a liquidity target. Equal highs and lows are the most obvious levels you'll find, which makes them the most reliable targets. Look at this real example of equal highs on the chart. You can see two or more swing highs forming at the same price level, a very obvious level that every retail trader can see. All those stop losses from short sellers and pending buy orders from breakout traders are stacked just above this level. Price makes a fast move up, sweeps above those equal highs, triggers all the orders, and immediately reverses down. The institutions got the buying volume they needed to sell. That's the equal high sweep. Now the same concept, but on the downside, equal lows. You can see two or more swing lows at the same level, and all the stop losses from long traders and pending sell orders are sitting just below. Price makes a sharp move down, sweeps below those equal lows, triggers all the orders, and immediately reverses upward. The institutions accumulated their long positions and now they want price to go up. That's the equal low sweep, and once you start looking for it, you'll see it everywhere. The stop hunt is what a liquidity sweep looks like from the retail trader's perspective, and it's one of the most important things to understand in all of smart money concept. Here's exactly what happens. First, retail traders go long and place their stop loss below the last swing low, the most logical place, exactly what every trading book teaches. Second, the institutions know where those stops are and push price deliberately toward that swing low. Third, price breaks below and every single stop loss triggers automatically, creating an avalanche of selling. Fourth, the institutions absorb all of that selling volume and use it to execute their massive buy orders at a very favorable price. Fifth, price immediately reverses upward. The retail traders are out of their trades, watching price go exactly where they predicted, but they're no longer in. This happens every single day on every pair. Now that you understand the mechanism, you can anticipate the stop hunt instead of being the victim of it. Here's a real stop hunt. Clear swing low with stops sitting below. Price breaks under it for one or two candles. The stops trigger and then immediately reverses up. The speed is everything. One or two candles below, then straight back up is a stop hunt. Multiple candles staying below is a real breakdown. Now the practical part. Here are the 6 key levels you need to mark as liquidity on your charts before every trading session. The first two are equal highs and equal lows, which we already covered, the most reliable targets because they're the most visible. Then you have significant swing highs and swing lows, any major peak or bottom where the market clearly reversed, with BSL above and SSL below. And finally, the two most important daily levels, the previous day high and the previous day low, which institutions target almost every single day. Mark these every morning before the market opens without exception. The key point is that you don't need to mark everything on your chart. 5 to 8 clean levels per session is enough. More than that creates noise, not clarity. Focus on the obvious levels because those are exactly the ones that will be targeted. Combining liquidity with market structure is the most powerful thing in this video. If the higher time frame structure is bullish, you wait for price to sweep the sell side liquidity below, then go to the lower time frame, look for a change of character confirmation and enter long. If the higher time frame structure is bearish, you wait for the buy side liquidity sweep above, confirm on lower time frame and enter short. Structure gives the direction, liquidity gives the entry trigger. Instead of getting stopped out, you anticipated the sweep and entered after it. Here's a complete real example on gold 4-hour. The higher time frame structure is clearly bullish, higher highs and higher lows. So my bias is long only. I identify the sell side liquidity below the last swing low and I wait. Price sweeps the sell side liquidity. It goes below the swing low, triggers all the stop losses. Zooming into 15 minutes for the entry. After the sell side liquidity sweep, I look for a change of character that confirms the bearish move is over and the bullish move is resuming. I enter long after the change of character confirmation. My stop loss goes below the lowest point of the sell side liquidity sweep. My take profit is at the next buy side liquidity level above. This is the complete process. Structure gives the bias. Sell side liquidity sweep is the trigger. Change of character gives the entry confirmation, and the next buy side liquidity level is the target. Before we finish, let me cover 3 mistakes that traders make with liquidity. The first mistake is thinking that every sweep leads to a reversal. A sell side liquidity sweep in a bearish higher time frame structure is not a buy signal. It might just be continuation because the institutions are adding to their short positions. Always check the higher time frame context first. The second mistake is entering at the exact moment of the sweep. Price can always extend further before reversing, so you need to wait for the lower time frame change of character confirmation before entering. Missing the first few pips is always better than getting stopped out. The third mistake is marking too many levels as liquidity. If you mark everything on your chart, it becomes impossible to read. Stick to equal highs, equal lows, the previous day high and low, and the most obvious swing points. 5 to 8 clean levels is all you need. Next video, fair value gap. What it is, how to identify it, and how to combine it with order blocks and liquidity for even more precise entries. Drop a like if this video helped, subscribe to follow the complete Smart Money Concept series, and tell me in the comments, have you ever had your stop hit and then price went exactly where you predicted? Because now you know exactly why. See you in the next video.